So, what's the difference between a hedge fund and private equity? If you're wondering which one is a better job for you, or where the best place to put your money, or just curious and want to sound smart at your next dinner party, I got you covered. It used to be that it was easy to tell a hedge fund from a private equity fund, but the differences have blurred over the last few years, and we'll talk about why. Today, we're going to talk about what each is historically, how that has evolved over time and blurred the lines between what they are, and then my top tip for what makes a great private equity fund and a great hedge fund. All right, so first, let's start with private equity funds. Private equity funds focus on investing in private companies and generally through a leverage buyout model where the returns are generated primarily from leverage or the debt that they use to buy the company, plus multiples expansion and operational improvements in the business. As we've talked in other videos, the idea with a private equity fund is they go out and they buy the whole company. They use part of the money they use to acquire is equity and the other part is debt. And because of that, they're able to put, maybe they buy a $100 million business, they'll put $40 million of cash into it and borrow the other $60 million. Then they'll use the cash flows of the business to pay down the debt that they brought on when they bought the company. And by doing that, if all you do is pay off the debt and then sell it to somebody else, you will have generated a 2.5 times return on your money, which is pretty good. And then you can do lots of other things. You can grow the business, you can improve margins, you can expand to new markets, you can acquire other businesses and bolt them on and gain efficiencies. There are a lot of other ways to even juice the returns beyond that. Private equity also generally refers to venture capital, and venture capital and growth equity investing kind of fall under that private equity bucket from the perspective of they are making investments in equity that is privately held, right? Venture capitalists aren't investing on the public stock exchanges, right? Anyways, I bring that up because when we talk about hedge funds, you'll start to see where the lines start to blur. Hedge funds first started years ago using what's called a long-short strategy. The basic idea was that they would invest in public companies that were undervalued or underpriced, and then they would short companies that were overpriced. Or in other words, they would place a bet that that company was going to go down in valuation because it was overvalued. And by doing so, they could make money on the difference between the two, like a lot of money. And lots of funds will do things like go long, invest in a company that they think is the future of the industry, like Airbnb. And then they'll short companies that they think will be disrupted by Airbnb, like hotel chains. Or maybe you go long, right? You make an investment in a company, but you short the overall market. This takes out the price fluctuations from the market moving outside of the long position performance of the company. So these are like relatively well-known investment strategies that different hedge funds will use. Plus, since then, they've layered on all kinds of things from high frequency trading to emerging markets, or it could be strategies where the hedge fund buys a significant portion of the company and then uses that position to push the company around to change what it does, maybe to sell part of the business or to change their cost structure or whatever it might be. There are a lot of different hedge fund strategies out there, and they don't just apply to public equities anymore. It could be crypto, it could be real estate, it could be a lot of different things. Which brings me to this whole idea of blurred lines between private equity and hedge funds. So clearly, hedge funds have evolved quite a bit over the years, and they don't all implement a long-short strategy or what have you. What it's really become known for is just a name of an investment firm with a proprietary investment strategy, right? They could be like activist-driven, like Carl Icahn, could be lots of different strategies, and they are often super secret about those strategies because, like they say, money doesn't grow on trees. And what they mean by that is that there's not free money out there, and the reason for that is twofold. Either one, if everybody knew that there was free money out there, they'd all compete for it until it was no longer free. And so two, if it does exist, the people that know about it keep it super quiet because they don't want anyone else to know about it, right? And that's what hedge funds essentially do. If they've figured out some strategy, some trading strategy where they can make a lot of money, they're very quiet about it because they don't want anyone else to know. This is the proprietary side of what they do. Now, if you think about my earlier example with Airbnb, right? Well, Airbnb, just like many other companies, are taking longer and longer and longer to go public, right? And so if you're a hedge fund and you are used to investing in companies that have high growth, there may not be very many of those that are publicly traded anymore. By the time a company goes public, it's kind of fairly well established. And even if it's growing, it may not be growing as much as it used to. And so running those long short strategies, for example, can be challenging, right? So what hedge funds have started to do is they've started to play in the private side, where they'll make investments in growth equity companies, right? They may still, in this case, before Airbnb goes public, they may buy into Airbnb, buy that stock while simultaneously shorting the overall hotel industry and still thereby get their long short strategy. The other thing too is that a lot of funds will just say, hey, the growth in growth equity right now and the returns that you can generate are really strong. And so as a hedge fund, they may just go and compete with venture funds and growth equity funds for allocation to those deals. Tiger Global is a really good example of this, where although they have a very strong public equities investment arm, they also have a very, very strong private equities investment arm where they are investing in high growth startups and capturing some of the return there too. Anyways, as private equity funds move in to the field and the arena that's traditionally been for venture capital funds, it's become really challenging for some of those VC funds because hedge funds tend to be a little less price sensitive. They're swinging for the fences over a very long period, unlike venture funds that may want to see a return in 5 to 7 years. A hedge fund may come in and say, hey, look, we're going to buy this and we're going to hold it for a lot longer, even after it goes public, which is really challenging for most venture funds. Most venture funds, when they invest in a company and the company goes public, they're getting pressure from their investors to sell the shares. And the reason for that is because, frankly, venture capitalists charge a lot of money in fees to manage the money that investors give them, especially when you compare that to public equity investors. A mutual fund manager may only be charging kind of 0.2%, whereas a venture fund is charging 2%. So it's 10 times more expensive for a venture capitalist to manage the money than a public equities manager. And for that reason, a lot of investors put a lot of pressure on VCs to sell early, whereas a hedge fund doesn't have that same restriction, right? They can invest in whatever they want as long as they're generating a good return for their investors. Just a recap on everything. So you have private equity as this broad blanket statement, right? This broad category of equity that is private. And within that, you've got private equity firms that do leveraged buyout. You have venture capital funds that are investing in high growth businesses. You have growth equity, which are investing in businesses that are fairly well established but still growing quickly, but are still privately traded. And then you have hedge funds that are starting to participate more and more in the private equity space, as well as the public equity space, which has traditionally been more of their purview, buying and selling stocks on the public markets. So hopefully that was a helpful explanation of the difference between private equity and hedge funds. Maybe after this, you're like, I think it would be really cool to start my own fund, whether it's a venture fund, private equity fund, or hedge fund. Here's my top piece of advice. The best funds, private equity or hedge fund, in my opinion, are the ones that can help their companies create real value. It's not about complex financial engineering. It's about actually rolling up your sleeves and helping companies grow and outperform. Other companies that use financial engineering may outperform in the short run, but those that add real value to a company outperform in the long run consistently. At least that's what I've seen over the last 14 years of venture investing and growth equity investing, is that the very best investors are the ones that can get in and help the company really succeed. And they're the ones that are able to generate outsized returns. If this was helpful and you want to learn more about venture capital, check out my next video where I talk about how to get an internship in venture capital.